Assalamualaikum. This week we are going to do our last chapter in FIN658, that is financial analysis. Alright, so this is the outline of our last chapter. It consists of a cash flow analysis, prospective analysis, credit analysis and equity analysis. So please take note that you can refer the lecture for cash flow analysis in the previous video shared on YouFuture and my YouTube channel. Okay, we're going to start with the prospective analysis. The prospective analysis is a process of forecasting the future financial information. It is actually the final step in the financial statement analysis process. So the technique that can be used to do the prospective analysis of financial statement forecasting and also valuation. Okay, so for the security valuation, alright, so the free cash flow and residual income models require estimates of future financial statements. So in here we are going to look at the intrinsic value of the security and compare it with the market value, and then to decide whether to buy, to hold or to sell the security. Okay, next for the management assessment. Alright, so it requires forecast of financial performance, examine the viability of companies' strategic plans. And then the last one is the assessment of solvency, which is a prospective analysis that is useful to creditors to assess a company's ability to meet debt service requirement, both for short-term and also long-term. Alright, next, how to forecast and planning. Okay, so we can do financial forecasting, okay, for example, using the percent to sales method. Alright, so in this method, we're going to prepare or construct the pro forma balance sheet and income statement. So this is a fund forecasting. Okay, by constructing the pro forma balance sheet, okay, we are about to estimate the increase in assets due to increase in sales. And then we are going to estimate additional funds needed, whether we are going to use the internal or external fund. Okay, by preparing the pro forma income statement, alright, it is about to estimate the changes of sales, and then we are going to determine the forecasted net profit, and then to use the assumptions given. Alright, here's the steps to follow to prepare the pro forma balance sheets. Okay, number one, calculate the percentage increase in sales, and then number two, we tabulate the items that vary with sales in the pro forma balance sheet. Okay, so please take note that all operating current assets, excluding the marketable securities, and the operating current liabilities, excluding notes payable, will vary. Okay, or you follow in direct proportion with the percentage increase in sales. So for example, 25% increase in sales, we increase the account receivable by 25%. And also the fixed asset also increase in direct proportion with the percentage change in sales. Alright, next, you can calculate the new retained earnings. And then number four, the difference between the total assets and the total liabilities in your pro forma balance sheets, okay, are the amount of external funds needed or external funds required. Alright, next is credit analysis. Okay, under the credit analysis, we're going to look at the liquidity and solvency. Okay, we know that the solvency and liquidity are both important for a company's financial health. Okay, liquidity refers to the company's ability to meet the short-term obligations, and also to look at the ability to convert assets into cash or to obtain cash. So if the company is facing lack of liquidity, it can cause the company lose the advantages of favorable discount and maybe lose the profitable opportunities. Alright, and then the severe liquidity often lead to lower profitability of the company, and the restricted opportunities, loss of owner control, loss of capital investment, and maybe cause the insolvency and bankruptcy to the company. Alright, next is solvency. Okay, we can see here the asset versus liabilities. Okay, so the solvency measures the long run financial viability and its ability to cover long-term obligations. Okay, financial viability and ability to cover long-term obligations. Alright, so when we are calculating the solvency ratio, one of them is the debt to equity ratio, which is it measures the capital structure or the financing sources of the company, whether the company is issuing equity or using debt financing for their capital structure. And we also measure the earning power, which is the recurring ability to generate cash from operations. And also in the solvency, we're going to look at the loan covenants, which is loan covenants is the protection against insolvency and financial distress that they define default, okay, and the legal remedies available when it occurs. Okay, this one is to allow the opportunity to collect on loan before severe distress, or in other words, or in the simple word, we can say that the loan covenant is an agreement stipulating the terms and conditions between the borrower and the lender in a loan obligation. Alright, next is debt financing versus equity financing. Okay, so there are two types of financing available to a company when it needs to raise capital. So the company can issue equity or use the debt financing. So the main advantage of equity financing is that there is no obligation to repay the money acquired through it, and then the uncertain and unspecified return, so the dividend is not fixed, and then it can contribute to company stability and solvency. While through the debt financing, the interest must be repaid, and then the specified repayment pattern. So let's say the company is issuing a bond, so the repayment pattern is fixed or specified. Let's say the bond is annually compounded or semi-annually compounded. Alright. So when the proportion of debt financing is higher, the higher the resulting the fixed charge, which is the coupon rate or the interest rate, and the repayment commitments. From a shareholder's perspective, debt financing is less expensive than equity financing. Why? Because number one, financial leverage. Okay, so the interest on most debt is fixed, and provided interest in debt less than the return earned from equity financing. It's not debt, equity financing. Okay, so the excess return goes to the equity investor. And then number two, because of tax deductibility. Alright, so the interest is a tax deductible expenses, whereas dividends are not. So that's why the shareholders think the debt financing is less expensive than equity. Okay, now let's have a look at equity analysis. Okay, we have fundamental analysis versus technical analysis. Alright, fundamental analysis involves analyzing a company's financial statement to determine the fair value or the intrinsic value of the stock. Okay, so we determine the value without reference to price. Okay, we calculate the intrinsic value like using a dividend discounted model. Okay, other than that, the fundamental analysts also analyze and interpret the economy. Okay, interpret the economy by looking at the economic indicators like the GDP, interest rate, inflation rate, unemployment rate, and so on. Alright, and then the analysts narrow down the analysis into the industry, which is looking at the specific sector that they would like to invest in, and then lastly focus on the company. Alright, so when focused on the company, we can do the financial statement analysis like calculating the financial ratios or do the year-to-year changes to see the performance of the company. Alright, and then help the investor in the decision whether or not to invest in that company. And then the technical analysis is a method of determining the future price of the stock, okay, using charts and patterns in price behavior or volume history. So this is useful to predict the future price movement. Alright, and then the decisions are based on the market trends and price of stock. Next, equity analysis using the residual income model. Okay, so using this model, one of the key variable of the residual income model is the book value. Okay, the advantages of residual income valuation, okay, compared to the dividend discounted model. Okay, so the book value is readily available and subjected to auditing procedure. Okay, and then the other key variable are future net income and cost of capital, and then the net income is generally considered easier to predict than the future dividends. Okay, because in the DDM we calculate or we predict the future dividends, right? Okay, and then the cost of capital must be estimated in all of the valuation models, and the primary limitation of the residual income model is that it requires predictions of earnings for the life of the firm. Okay, so this is the formula to calculate the intrinsic value of the stock using the residual income model. Okay, so the VT is the value of the stock, BV is the book value, okay, E is the expected, RI is the residual income, okay, for the period T plus N, okay, and then the K is the cost of capital, alright, and then E refers to the expectation. Okay, so after we calculate the intrinsic value and then we compare with the market value, so here comes the decision whether to buy or to sell or to hold the stock. So if the intrinsic value is higher than the market value, then we should buy. So if the intrinsic value lower than the market value, we should sell. And then if the intrinsic value is equal to the market value, it's okay to hold the stock. Okay, so that's all for this chapter. Thank you.